Let's start by looking back in history. Asian economic crisis in the late 90s.
Yeah.
I think you can't help but wonder if this continues, Fed hikes rates, market sell-off, could something like that repeat itself now?
I think things are much better than 1997 when the Asian financial crisis broke out. Back then, emerging markets were borrowing in dollars short-term from the global banks. Now the structure has changed very much, and they've remedied many of the weaknesses. So, for example, they're now much more reliant on the bond market, and for the sovereign bond market, they borrow in local currency. But having said all that, that still hasn't quite insulated them completely from global conditions, because global investors are a big part of the local currency sovereign bond market. For Indonesia and for many other countries, the participation of global bond investors in the local currency sovereign bond market is up to 40%.
When you look at a country like Indonesia, so many people here and everywhere say it's an emerging market that has done just about everything right, and yet they have one of the worst performing, one of the hardest hit currencies in Asia this year. Why? What should they do? What haven't they done?
It just shows that the risk appetite of global investors, they fluctuate. And for local currency sovereign bonds, the currency moves tend to amplify the gains and losses. So when the dollar is strong and the rupee is weak, then the high yields are accompanied by the currency losses as well. So that actually amplifies the gains and losses through currencies. And so when there is a pullback, the financial conditions in emerging markets tend to tighten more. Now, I think there's no magic bullet in the policy response. We have to do the basics right, build buffers, stronger macro fundamentals. But also, I think there needs to be a certain amount of self-awareness that when the going is good and there's plentiful funding, this is not simply a vote of confidence in your policy. It is also a reflection of global financial conditions. And so don't be tempted to drink too much from the fountain of global liquidity.
Well, I'm glad you touch on that, because that's the crux of the matter lately, isn't it? Just was it 2 weeks ago we had that one, especially one big day of moving up in U.S. Treasury yields. A couple of days ago we get this big sell-off in stocks. Central banks are pulling back a lot of that liquidity, certainly the Fed and now the ECB. So when you talk about global conditions changing, boy, it seems like they've had quite a change dramatically just in the last few weeks.
Yeah, so the bond market has undergone some changes recently, and I think the backdrop here is that we're emerging from an extraordinary period when term premiums were negative. And so, the long yields were kept low through central bank policies, which were needed to take us out of the crisis. But it means that as central banks lift their finger from the scales, the term premium will have to decompress. And so we are seeing real yields going up. So I don't think it's anything extraordinary. We are going back to what is somewhat normal. And you were there at John Williams' conference on Wednesday when he gave this very important speech about now we're entering the realms of the normal, and we should be thinking about monetary policy in the normal context.
So let's bring in trade war angst, and maybe even with a special look at Korea, a very, export-dependent country intertwined in these global supply chains. How big of a factor is that in terms of what we're seeing in emerging markets, their currencies being hit, the global gyrations in these massive bond markets?
I think, the key thing, Kathleen, is that exchange rates have more than simply this trade rebalancing channel. There is a financial channel of exchange rates, and we see it in the fact that when the dollar is strong, financial conditions are tighter. And it turns out that, when we look at this empirically, looking at trade volumes, looking at real investment, the dollar exchange rate seems to also have a very important effect on real variables as well. And to that extent, the dollar exchange rate is a barometer of risk appetite.